Hi, I'm Kamal. I hope you're safe and doing well. Welcome to my channel InvestWise. It's a well-known fact that amongst all asset classes, equity markets give the best returns for the long term. But despite that, many people stay away from investment in stocks or have burned their fingers due to not following the basic rules to earn profits or weren't able to capitalize on the full returns offered by the markets. So without wasting any time, let's get on with the topic of the video. Watch it till the end to know the golden rules for investing in stock markets and enhancing your returns. In the equity markets, investing for the long term is the basic mantra for generating enormous wealth. You cannot generate wealth if your investments are for very short term. And all the big investors have invested over long periods of time, which is why they are where they are today in terms of their wealth. The stocks don't multiply in value overnight. They take time to consistently prove their performance, and the market rewards them very handsomely. And all those stocks, while their prices may be very high today, but they were small stocks a few years back and at quoting at very low prices. Two, buy quality stocks which have a proven track record as well as good growth potential. So all stocks which you buy may not be very high priced. They can be small stocks, but the most important point is that their track record till now should be good and they should have good growth potential which can earn them profits for many years going ahead. So it's important to look at the quality of the stock, not the price of the stock. Don't try to catch a falling knife. A very important reason why people lose money is that they want to buy stocks which are falling because they feel that now that the stock has fallen, it's a very good buy. So people who don't own the stock, they buy it because they think that it's very cheap and they will earn handsome profits if they hold the stock for a long period of time. And the people who already had the stock, they will add to it to average their cost. But unfortunately, this doesn't work in all cases because while some stocks do reach their earlier highs or even make new highs, not all stocks do that. So it's best to wait and see if the stock keeps on falling or it stabilizes and reverses. But more importantly, you should also see whether the stock's fundamentals and growth potential are intact and there are no serious issues in the company. No one can time the markets perfectly, but it is possible to sell very near the highs and lows in some cases. For example, in this year's market crash due to COVID-19, it was known that it has become a pandemic and any savvy investor could have sold early because it was well known that this is spreading globally and it would have a global impact, including economies of our country. Even before COVID-19, there were slowdowns happening in various countries, and while markets may not have started selling immediately, but selling would have eventually begun to happen when investors would have started realizing that the growth will not happen as much as it was happening till now. Even in the financial crisis of 2008, the market fell heavily, but this fall did not happen overnight, and people had time to sell well before the market reached their lows. But to sell at highs and lows, one must be aware about what is happening. So, one should not feel that no one can time the markets, no one can sell high, sell low, but it is possible, although in some cases, and one has to be aware of those cases. There are times when markets start showing signs of initial selling because of some adverse news, which may have a very lasting impact. So, it is better to exit then and re-enter when there is stability and when the markets begin to rise again and some positive news begins to emerge. Similarly, if a stock has run up too much, there is no point in chasing that stock because that stock may have been already in overbought state. And when a stock is in overbought state, it is only a matter of time when the stock begins to fall due to profit booking. So if you buy the stock when it is at a very high level, then there are greater chances that you will incur a loss rather than uh, getting a profit from the stock because you might enter but others might start selling and you might lose money. So when a stock is run up too much, it is better to concentrate on other stocks which have not gone up so much till now but have better prospects of going up in the near future. Number 5. Stocks don't go up and down in a straight line. This is due to a phenomenon called the Fibonacci retracement. So whenever you see the chart of a stock, it will go up in waves. So for example, the wave can be like this. And even while coming down, the wave will be like this. So basically, either when a stock is going up, it will always take breaks and keep coming down. The fall may not be very heavy, or even when the stock is falling, it will not fall in a straight line. There will be pullbacks along the way. So whenever you're buying or selling a stock, you should be aware of where the pullback might happen in on the way up or on the way down, so that you can take maximum benefit out of this. If the stock is going up, you can sell it when it is about to fall in a downward wave and buy it at the lower price. Similarly, if a stock is going down, you can wait and see if the stock gives a pullback on the way up and sell it at a higher price. And in this way, you can minimize your losses and maximize your profits. Number 6, don't follow others blindly or act just on unsolicited tips. What happens is that when you follow others blindly or follow unsolicited tips or act on unsolicited tips, you don't know what the reason for the stock going up is. And there are chances that when you buy that stock based on just a tip and not knowing the exact reason of why it is supposed to be going up, then chances are most likely that you will incur losses in buying that stock. So it is important to hear people out, but at the same time know the exact reason of why they are saying what is about to happen. Number 7, keep emotions aside while taking investment decisions. It's very important to keep a stop loss and adhere to that stop loss, because otherwise, if the stock goes below your buying price, then what people tend to do is that they tend to get so emotional that they don't want to book losses, and their losses keep on increasing. So it's very important that you don't be emotional and immediately book the loss if your investment goes below your buying price. Number 8, diversify your risk by diversifying your portfolio. Do not keep your investments in one stock or in one particular industry, because if the going is good, then you'll make decent profits. But this is also equivalent to keeping all your eggs in one basket. If the there are adverse developments regarding that industry or even in that particular stock, not only will your profits turn into losses, but it will also erode your capital, which is very important in equity markets. Monitor the developments and the companies in which investment has been done. Now, a lot of people sit pretty because they've invested in good companies and they forget about them, thinking that they don't need to be monitored or kept track of. But that's completely incorrect. That's not the way to do it. News and results related to stock should be regularly monitored, and all the more so, especially when the stocks start moving down, because there are so many stocks which were once big companies, but today they are penny stocks. And the reason why people suffered heavy losses in these stocks is because they did not monitor the stocks, they did not monitor the developments, and before they realized what was happening, the stock was down to rock bottom. So, if the stock is currently facing problems, it is better to exit early, and if prospects improve at a later date, it can be bought again. Number 10, be aware of the risk but not afraid of it. Everything in life is a risk, but that doesn't mean that we should be afraid of everything in life. Similarly, all asset classes which give higher returns are fraught with risk, and the risk in stock markets is not unmanageable, and the rewards are also very high. So we should try and understand the concepts to enhance our chances of higher profits. The only thing we need to keep in mind is that while investing, we should not invest amounts which we would need in the near future and invest only surplus funds, so that we can keep the investments for a longer period of time, and we should also invest in better quality stocks to enhance our returns. In the upcoming videos, we will discuss many important concepts which will benefit you in terms of taking your own decisions. I will be making regular videos on important developments and announcements with respect to stocks. And I will also be recommending certain stocks for educational purposes, which you can monitor and you can see that it is possible to identify stocks which can either go up or go down, and hence you can enhance your profits. If you found this video useful, please like it, and please also subscribe to my channel and turn on the bell notification for my upcoming videos which will enhance your knowledge and help you increase your profit and add to your wealth. And I would very much like you to give your inputs and suggestions, and feel free to ask any questions. Thank you so much once again, and take care.